Today, household financial confidence crashes. Hello again, it's Martin North from Digital Finance Analytics World Basis Posts, covering finance and property news with a distinctively Australian flavour. The latest edition of the DFA Household Surveys up to the 31st of March 2020 reveals in painful detail the impact of the current health emergency. Not that confidence was particularly strong beforehand, thanks to the high cost of living and flat real incomes for several years, but the shock of the economic freeze and rising joblessness has dropped the index to levels I have never expected to be seen. Last month it has fallen to 80.2, but the latest read is 73.2, well below the average 100 level last seen back in May 2017. The 52,000 household surveys asked whether their employment prospects, income, costs, loan savings and net worth were higher or lower than 12 months ago. Coupled with other demographic data we collect, we're able to examine the results across a range of dimensions, though this month it hardly makes a difference as every age group, state, property status and more were down. We normally display the results before looking at the drivers, but this time we examine the individual elements first. Job security fell by 25% compared with the previous month, with 64% of households now less secure than a year ago, 44% about the same, down 3%, and 4% more secure. The economic freeze, which has impacted over this period, explains the sharp moves. There was also a spike in those indicating a fall in incomes, with 60% of households reporting a real fall, up 7%. 38% saw no change, but this was down 3%. Significantly more households were concerned with their debt burden, with 60% of households now more concerned than a year ago, up 15%, 4% more comfortable, and 37% about the same, down 3%. Whilst lower interest rates are helping those still employed, it is irrelevant to those who have lost employment, and it will be even worse but for the government support and mortgage repayment holidays. The costs of living continue to climb, with 95% of households reporting higher costs than a year ago. And household comfort with their level of savings dropped significantly, with 59% less comfortable, up 16%, with 37% about the same. Not only will lower deposit rates continue to impact, but significantly more households were caught by the sudden drop in earned income and so are more reliant on savings. Many of those who have income said they will now save more given the current uncertainties, so that's more bad news for discretionary spending. Overall net worth, assets minus loans, fell for 64% of households thanks to drops in share market prices, falls in the value of superannuation and some property price falls. This was a rise of 17% compared with last month. 27% stated their net worth was higher, down 3%, and this was directly connected with the still reported property price rises in the eastern states. Households tend to overestimate the value of their properties, especially given the near collapse of auction clearance rates and property sales. This may well be a case of hope over expectation. So in summary, the moving parts have shown a shocking shift in a short period. This translates to significant adjustments in the index results. All property owning segments reported a significant drop, with owner-occupied property holders reporting the biggest falls, as they have been relatively more optimistic than other groups until now. Across the states, they all fell, though New South Wales and Victoria reported the largest new reductions in confidence. No state was immune from the falls. All age groups reported a fall, with older age groups falling greater, not least because of the stock market falls and the risk of job loss. People above 50 were more concerned about never getting another job, with all of the implications for retirement, and many said that they will actually need to work for longer before retiring. Finally, our wealth segments all reported a fall in confidence, but the free affluent group, those without a mortgage and with property market investments, dropped the most. This was the segment which up till now has been most insulated from events. So this is a really bad result this month. It'll be interesting to see whether this is a blip or whether this is the start of a whole new trend, but this will be determined by how long the economic freeze continues and how quickly we bounce back, if and when we do. We'll keep reporting the data each month. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.